Listen up, because we're diving right into this explainer by looking at a piece of classic financial advice that, honestly, could be a fatal trap for your credit score today. If you've ever thought about getting a personal loan to clear out your credit card debt, you really need to pay close attention. What used to be a super clever financial hack could now completely derail your future. And it's all because of a massive shift in how lenders are evaluating you. For years, we've all been sold this very specific story, right? If you have high interest credit card debt, you should just take out a lower interest personal loan, consolidate that debt, and pay it off. I mean, it sounds incredibly responsible. Well, there's a new algorithm in town, and it might severely punish you for doing exactly that. The rules of the game are changing incredibly fast, and the exact strategies that used to boost your score might actually be the things tearing it down right now. There is just a stark contrast between how things used to work and the hidden reality of the new credit scoring landscape. The old advice told you to consolidate to drop your credit utilization immediately. Boom, instant score boost. But the new reality is governed by a model called FICO 10T. And FICO 10T actively hunts for and heavily penalizes a behavior known as debt recycling. Now, if you don't know what that means yet, don't worry at all. We're going to break it down entirely, because this is the exact mistake catching so many consumers off guard. Let's look at the timeline of how we actually got here so you can understand why this is so urgent. The credit industry, it moves slow, but when it moves, it completely shifts the landscape. So FICO 5 came out in 2004 and is actually still used in a lot of legacy mortgages. Then FICO 8, released in 2009, well, that's the standard you're probably most used to seeing for your credit cards. Now, FICO 10T was actually introduced back in 2020, but here is the kicker. Summer 2026. That marks when Fannie Mae and Freddie Mac begin coordinating the use of FICO 10T for mortgages. The transition is literally happening right now. And this is exactly why this matters today. If you're planning to buy a home, this new scoring model is going to dictate your mortgage rate. The Federal Housing Finance Agency, the FHFA, has officially approved FICO 10T for use by Fannie Mae and Freddie Mac. These are the two massive government-sponsored enterprises that guarantee conforming mortgages here in the U.S. So even if your local credit card issuer hasn't upgraded yet, the biggest players in the housing market absolutely have. The wheels are already in motion. All right, Section 1, meet your new score, the 24-month memory. We're going to look at exactly how FICO 10T differs from the old models you're used to. The best way to think about this is like a shift in technology. The old FICO 8 model, it was basically a Polaroid snapshot. Lenders looked at it, saw your balances on that one specific day, and judged you based entirely on that single frozen moment. But the biggest leap forward with the T in FICO 10T is trended data. It's not a photo, it's a 24-month video recording of your debt. It doesn't just look at where your balances are today, it sits back and watches the entire movie of how you got there over the last 2 years. As it watches this 24-month video, the algorithm tracks your trajectory to put you into one of two buckets. You're either a transactor or a revolver. Now, transactors are users who might use their credit lines a ton, but they consistently pay their balances in full every single month. Revolvers, on the other hand, carry those balances from month to month and usually just make the minimum payments. Under the old Polaroid models, it was kind of unfair, right? A transactor and a revolver could have the exact same score if their balance was identical on snapshot day. Well, not anymore. The algorithm now actively penalizes the revolvers. Let's put this into perspective. Imagine you have a 30% credit utilization rate right now. Under FICO 8, a 30% utilization rate was just a static number. It looked at 30% and said, okay, sure, that's fine. But FICO 10T demands context. If you hit that 30% because you've been steadily grinding down your debt from 60% over the last 6 months, FICO 10T sees that downward trend and rewards you. But if you've just been hovering at that same 30% for 2 straight years, paying just enough to tread water, FICO 10T will actually dock your score for having a persistent high balance. Let's move to Section 2, the debt recycling mistake. This is the trap where the old advice crashes headfirst into the new algorithm. Okay, here's how this trap works step by step. Step 1, you realize you have way too much revolving credit card debt, so you apply for an installment personal loan to consolidate it. Step 2, you use that loan to pay off the credit cards entirely. So far, so good. Your utilization drops to 0. But then comes Step 3. Look, we're all human and sometimes used to come to temptation. Your credit cards have 0 balances, so you start using them again. And before long, you run up new credit card debt while you're still paying off that original personal loan. FICO 8 was honestly largely blind to this pattern. It just saw that you had an installment loan and some new revolving debt on the day it took its snapshot. But FICO 10T's trended data, it sees the whole timeline. It sees the exact debt recycling behavior over 24 months, paying off revolving debt with a personal loan only to immediately rack up more revolving debt. And because it can see this pattern, it severely penalizes your score for it. Lenders view this as highly risky behavior, and now the algorithm totally agrees with them. And this isn't just about a few arbitrary points on a screen. Juggling balances and maxing out those credit cards again could literally be the difference between getting approved for those house keys or getting outright rejected. When you go to apply for that conforming mortgage in 2026 and beyond, the lender is going to see your trended data. If they see a cycle of debt recycling, you might find yourself locked out of home ownership entirely, or, saddled with a crazy interest rate that costs you tens of thousands of dollars over the life of the loan.
All right, Section 3, how to protect your score. We know the rules are changing, so how do we actually adapt? Let's break it down. First off, take a deep breath because some fundamentals absolutely never change. Paying your bills on time, every single time, still makes up 35% of your score across all FICO models. This is your strongest shield for sure. Whether it's FICO 8 or FICO 10T, late payments are just devastating. In fact, FICO 10T can be even more sensitive to recent missed payments. Being a transactor who never misses a due date, that is the absolute baseline for a stellar score. Next up is how you handle the credit you actually have. While 30% used to be the golden rule for utilization, the landscape has gotten a lot stricter. Experts are now recommending you keep your utilization under 10% to show lenders you are completely 100% in control of your available credit. And remember, lenders look at this on a per-card basis as well as your overall average. So maxing out one single card, even if your total utilization across all cards is low, that can still hurt you. You need to keep it under 10% on every single card. Also, maintaining long-term accounts without frantically opening new ones or constantly juggling balances is super key. This represents 15% of your score. The age of your credit really matters. FICO high achievers often have an average account age of 9 years or more. Trended data loves stability. It wants to see a calm, consistent track record over the years, rather than a volatile history of rapidly opening and closing accounts just to chase points or shuffle debt around. So to wrap this all up, if you follow these universal boosters, you're going to satisfy both the old point-in-time snapshot models and the new 24-month trended data algorithms. Pay on time, keep those balances under 10%. Crucially, avoid debt consolidation with personal loans if there's even a slight chance you might run up those credit cards again. Pay down your installment loans consistently. Stop looking at your credit score as a snapshot and start looking at the trend line of your overall financial behavior. And finally, before you make a massive purchase like a house, make sure you are monitoring multiple versions of your FICO score so there are absolutely no surprises. I'll leave you with this final thought. The game of credit is evolving right now. Lenders are getting smarter, their memories are getting much longer, and the loopholes of the past are slamming shut. So what's it going to be? Will you adapt your habits to prove you're a responsible transactor, or will a 24-month memory catch you totally off guard just when you need your credit the most? Thanks for joining me for this explainer, and I highly encourage you to go take a long, hard look at your credit trends today.